Morning, everybody. Good morning and welcome. Hope everybody's doing all right today. Hopefully you guys can hear me all right. Hey, Steve, how's it going, man? JK, nice to see ya. Guys, it is Monday. Monday, the 28th of October. Good morning, Jerry. Can't believe how fast this year is absolutely flying. Good morning, Hamid. Nice to see you. Bull Trader, great to see you. I'm going to assume that's a wave and not a request to take my microphone. Hey, Jeffrey Dean, nice to see you. Nanda, got you back. I love it. We got all the cool kids in here today. Welcome to the room. Man, hope everybody had a great weekend. Hope you accomplished something, smiled lots. Hey, Mariboy, thanks for the heads up this morning. Guys, we're going to get into this week, and honestly, it's going to look a lot like last week. Guys, just a heads up, whenever you ask me for the microphone, I politely decline. Nobody's allowed to have my microphone. There we go. I turned off the requests. Maybe that'll help. And guys, I want to show you, and I'm going to put this picture up, just a little PSA for the morning. Guys, I will never ask you for money. To be honest with you, I don't friend request people. If you guys friend request me, I always say yes. But I won't send that out there. I won't solicit funds. I won't tell you that I'll trade for you. I won't ask you for crypto. And that goes for anybody and everybody in the Nexgen organization. If you get weird requests or people telling you that, hey, just send me your crypto and we'll trade an account for you. Guys, it's all scams. Don't fall for it, please. Every morning I come to forexfactory.com/calendar. This is my morning routine, or this is part of it anyway. And I come here not because I'm concerned about what news releases there are, but rather the impact that they may have on the market. So every time I come to forexfactory.com/calendar, I'm looking for high impact and medium impact news releases, because these are the ones that can create spikes and jumps and indecision and all that sort of stuff. And I trade patterns that have been proven to win more than they lose. So if there's something that could disrupt my patterns, I choose not to trade into it. I choose not to take trades into news. I typically sit on my hands 3 to 4 minutes before. And then if there is an impact, I'll let the market get back to a pace that I'm comfortable with. And then I'll start trading again. But this is part of my morning routine, guys. That actually lends to the advantages. Everything that I talk about will come from the Nexgen page, guys. There really are no secrets in this classroom. Doesn't mean that I give you every ounce of information available to mankind. But what I will do, and my promise to you, is that I'm going to give you everything that you need to be successful with this software. Everything that I talk about comes from the trading guide. And the trading guide is one-stop shopping. All of the rules, guys, these are the additional trades that you're going to learn. There's a lot of focus here. And the one focus, I'm going to go to the glossary of common terms, that we have every day, consistently. It's the exact same thing every day. And you know, it's funny because I thought about making in the glossary of common terms cliches that Mark Novak uses. And one of the ones is repetition creates recognition, ladies and gentlemen. Doing the same thing over and over, seeing the same thing over and over, associating rules with the exact same looks over and over. What that does is it burns it into your brain, and it makes it difficult to miss your opportunities if you focus on just getting good at these looks. We're going to start everything off with a high probability trade. This is my first hour each and every day. This high probability trade doesn't happen all day long, maybe 3 to 4 times a day, maybe. But what it does is it opens the door for you to be able to recognize, understand, and eventually take the other trades. So this is a foundation trade. This is the trade that every indicator on each chart, it agrees for the rules. Guys, you're going to have the strongest triggers and nothing between you and your targets. No termination conditions, guys. In this high probability trade, the way we teach it is a high probability trend trade, going with the trend. Um, and I do this because when you follow the rules for this highest probability trend trade, guys, what you're doing is you're looking at a trade that typically wins 70 to 80% of the time. When you win that much, that success breeds confidence. But the most important thing that this trade's going to do for you and the ones you love is it's going to teach you to read your charts. The goal is to become a chart reader. Sorry, allergies are kicking a little bit. The goal is to be able to look at your indicators and be able to say to yourself out loud, I have the advantages that I need to feel comfortable entering a trade. Excuse me, I'm so sorry. This high probability trend trade, guys, it gives you the ability to do this. And what you're going to find is that 90% of your day, I mean, honest to goodness, 90% of your day is just sitting on your hands waiting for advantages to come into play so that you can capitalize, so you can get in, so you can take those trades. And that's the 10% is actually taking the trades. But once you're comfortable reading your indicators, you're going to understand where the market is likely to continue. This is, for the brand new user, this is the entry for the highest probability trend trade. You will pinpoint exactly where the market is most likely to continue. You are going to begin to understand where the market is likely to go. This is going to help you with profit targets. In the beginning, they'll be very simple. As you learn to read your indicators more efficiently, you'll find that you will be able to hold for bigger moves and manage differently. And then finally, you're going to understand where the market is likely to stop. I like that this one's in the listing last because these likely to stop areas are what we call termination conditions, guys. Termination conditions tend to be the most active thorn in the sides of new traders because it's the termination conditions, these likely to stop areas. These are the ones that are going to keep you in that 90% roll. These are the ones that are going to keep you out of the market when the market isn't giving you what you need. So we're going to focus on this trade that only has 3 rules. Simplicity is my battle cry. Each rule creates an advantage. So rule number 1, when it's met and true, will provide you the advantage of momentum. When rule number 2 is met, you'll have a clear path. You'll have room to your targets. And then rule number 3 is specific to the highest probability trend trade, guys. And you're going to pinpoint exactly where the market is most likely to continue using this rule to define your entry area. These 3 rules only take 2 charts to get you where you need to be, guys. And the large chart is a very slow chart. It's a very broad stroke of a brush, and it shows the overall opinion of the market. The large chart's going to define the direction. It's going to define the momentum. It'll define the areas that may be problematic, guys. And rules 1 and 2 must be met on a large chart. When they are met, when those advantages are in play, you're going to turn to a smaller, faster chart. This is a refinement chart. It takes 1 bar on the large chart, and through the refinement process, because it's a smaller time frame, it breaks it down into about 20 to 30 bars, guys. And this is where the precision comes in. This is where you're going to pinpoint your entries, and this is going to allow you to reduce risk and maximize profits because of this refinement process. And that's rule number 3 for the new user. We use these 2 charts, and I like this visual. It reminds you who you're trading with or who you're trading against, guys. The large crowd, all of these people that establish trends, that create momentum, that react at key areas, guys, this is your large chart. And when they want things to go up and go up fast, that's precisely what happens. So the large chart leads the way. The large crowd leads the way. And the path of least resistance means that you just latch onto these guys and do what they're doing. Your small crowd is the small chart. And these are the people that create ripples, that create pullbacks, little retracements. They tend to fight everything that the large crowd wants. And they tend to fail about 70 to 80% of the time, whether it's intentional or accidental. You're going to use the refinement chart to pinpoint exactly where they're most likely to fail. This is your likely to continue area, guys. This is exactly where the high probability trend trade puts you into the market with the highest chance of success. So we're going to focus on the trigger line and the Fibonacci rules for when it's okay to trade this morning. I'm going to take each rule individually. I'm going to break it down for you. We're going to go look at it in the live market. We're going to take pictures of it. We're going to annotate those pictures so that we create a connection between our brains and our eyes. And we're going to learn them for when it's okay to trade. And I like that phrase, for when it's okay to trade, because this is like your first hint that says, hey, if your rules aren't met, if you don't have those 3 advantages in play, it's okay to sit on your hands and do nothing, guys. Trading isn't about gut feelings or hopes or wishes. Trading is taking patterns that have been proven to repeat themselves and then trading those patterns because they create a statistical advantage. So as you learn these rules, guys, simulate, practice, make mistakes. It's okay to make mistakes. Actually, I think mistakes are some of the best things that you can do, because every mistake gives a great lesson on what it is you need to avoid when things get real. Post your pictures in the room, guys. This is the first step in becoming a confident trader ASAP. Every week, I'm here and I'm available 15 hours a week. And my sole purpose in life is to teach you to read these indicators and give you feedback on the trades that you take. Hey, good morning, Rob. To look at the charts that you present, to talk about your chart reads, to make sure that you're reading them correctly. We'll look at your entries and make sure that you have the least amount of risk and the highest profit potential. So every time you post in the room, I want you to feel like it's a private session, a one-on-one with me. So make sure you tell me what you see, and we'll see if there's a way to potentially do it better. Good morning, Jason. Guys, the tech guy's in here. Greatest tech guy in the world. The goal is that you eventually don't practice the wrong trades, guys. You're going to work your way to having that consistency, to that following rules, but I want you to understand and I want you to be okay with it. You're going to break some rules in the beginning. Just let's look at them together and let's come up with a plan to fix them. I simplify. I encourage you to simplify. I'm going to give you a plan with 2 trades on it this morning, but it's going to be your study of the high probability trend trade that sets you up for the second trade. It's your study on the high probability trend trade that's going to teach you to read your indicators. It's gonna open the doors for you to find more opportunities, guys. You have to know what looks you're going to commit to, and that's the second piece of the puzzle to getting to where you want to be ASAP, guys. Use the spreadsheet that Nexgen gives you. The same spreadsheet that I drop into the chat box every morning like I did just now. This spreadsheet is one of the most underutilized tools, and in my opinion, I think it's one of the most important tools because it goes back to that idea that repetition creates the recognition that you need for these looks to become easy. So your first tab, there's 4 tabs. Well, now there's 5 tabs because I put a little how to study tab. First tab's trade tracking. Everything you do, guys, put your trade in there. Take your picture, drop it in, annotated charts. This is what I saw. This is why I did what I did. Talk about your advantages, whether you win or lost. It's okay to track your progress. And then there's a section that says feedback from class. This is where you're going to present in the room and you're going to say, hey, Mark, this is what I did. And I'm going to say something clever like, hey, Jay, I want you to see your entry versus the rules entry, right? We could have reduced risk a little bit. And then I might say, hey, Rob, man, first targets were rockstar. Let's look at this key area for potentially a second exit. Maybe you could have held for a little bit more. Or I might say, hey, Nanda, that's one of those termination conditions. And that's probably what created the bounce that took you out. Good morning, Miss Adriana. So guys, the feedback from class is going to help you focus on the patterns that are bringing you success and the things that are taking it from you. And that takes us to the second one. Every morning, look at what you did yesterday, guys. Every morning, ask yourself what worked and what didn't work. And much like you, I'm in the process of learning something new. I'm a couple weeks into it. And I'm about 600 pictures deep in my learning process. And I'm recognizing the patterns that are working, that are not working, and I'm taking pictures of them and I'm annotating them because it's all brand new. I couldn't be expected to have them committed to memory, right? So I'm making mistakes, but I'm taking pictures of my mistakes. But what I'm finding is that there's things that feel very relaxed and things that make me nervous. Trades where I feel compelled to hold for bigger moves and trades where I feel like I have to manage more aggressively, guys. And this is what the study process is. So if you go back each morning and look at what you did yesterday or look at what you did Friday, it's going to set you up for the day. You're going to start looking for these patterns that bring you success. You're going to begin to focus on the patterns that don't and work on avoiding them, guys. This will accelerate the learning process. And this is also, every time you post one of these trades in the room, I'm going to begin to recognize the patterns in you. You won't always like that I recognize the patterns in you. You won't always want to hear what you're doing wrong. But I feel compelled to tell you because my goal is to help you get to the success that you want. So use the spreadsheet. Track everything. And then, guys, again, recognition creates repetition. So the third tab here is the 101 tab. And I'm going to give you a sheet how to use this the most effectively. All this is pictures of the rules being met. What's it look like to have rule number 1 met, rule number 2 met, and rule number 3 met? And then there's the opposite side of the coin. What's it look like when my rules aren't true, when I need to be sitting on my hands, when it's part of that 90%? The more you fill this out, the easier your life becomes. There's the favorite trade section. Oops, I skipped over. There's the client trade section, where I have put almost 400 pictures of you guys using the software, embracing momentum and clear path. There's the high probability trend trade entries, both long and short, and the most basic mechanical approach to management that the new user could ever take. There's a whole section dedicated to patterns, because once you begin to read your charts, once you understand the very basic concepts, you're going to begin to see more and more, and you're going to begin to recognize things that tend to repeat themselves, and you may turn them into trades. Or you may say, whoa, this is a great reason for me to sit on my hands and do nothing for a minute, and then an entire section dedicated to termination conditions. My goal for you is that you take pictures and fill out the favorite look section, guys. Make it look like mine. Good morning, Christy. Nice to see you, man. The personal trade setups. Every time you take a picture of a high probability trend trade, drop it in there. As you begin to learn other trades, drop them in here, guys. This is your trading plan coming to be. You're gonna use a very basic management plan at the beginning, but it's gonna grow as you grow. Start using your management pictures. Take them, annotate them. I could have held longer. I should have got out sooner. The patterns that you begin to recognize, put them in here. But even more importantly, drop those patterns in the room and say, hey, Mark, I keep seeing this. Am I onto something? And then a whole section dedicated to termination conditions. So fill out that spreadsheet, guys. Take a lot of pictures. Ask for feedback. The whole thing is you have to know what you're doing right and wrong. And my job is to help you through that. So we're going to learn the rules. You guys are going to simulate and post. And then you're going to take so many pictures that this stuff becomes easy. And we're going to do it with the high probability trend trade, ladies and gentlemen. 3 rules on 2 charts. The first rule says large chart must have strong trigger lines. It's got to have strong trigger lines. That's the rule. Because when I have strong trigger lines, it creates momentum. Well, your large chart is going to define the trend and the momentum on that most current bar. And the trend is defined with the background color. The background is green, it's going up. Let's look for rules to be met for high probability trend trades long. If the background is red, the market's going down. Let's look for rules to be met for high probability trend trade short. Go with the flow, guys. When I have an uptrend, strong triggers means that my small triggers, these solid lines, have broken above and away from my large triggers, which are widening. Both are in the direction of the trend. Both are headed north. And guys, this breakaway, this space between the two, lets me know that the odds are favorable for the market to continue up. So odds favorable momentum is one of those phrases that you're going to hear in the room all day long. Did you have odds favorable momentum? When you went to take this trade, did you have the best look where the triggers separated, guys? It looks like scissors that have just opened. And when scissors are open, you can cut. You can get some work done. In the downtrend, background is red. Small triggers are below and broken away from the large triggers. The scissors are open once again. The space between the two lets me know that the odds are favorable for the market to continue down. Odds favorable momentum leads the way, guys. And as long as those scissors are open, you have the advantage of momentum. But when they close, when the small triggers work their way back inside of the large triggers, guys, we call this a weakening of the large triggers. And there's really 2 options with your trigger lines. They're either strong or they're weak. Keep it very basic in the beginning. Separation means strength. When I have separation, I'm going to use that smaller, faster chart. I'm going to look to buy Fibonacci support. I'm going to look to sell Fibonacci resistance. On your large chart, Very often, one single bar will grow one of these tails. This tail is that retracement on a small chart. You will get to the point quickly where you can pinpoint exactly where these tails are most likely to form when the rules are met. So I'm going to ask new users real quick, is everybody cool? Strength, weakness, advantage, disadvantage, rule met, rule not met, guys. And I want you to get to the point to where the only reason you'll ever enter a trade is because your rules are met. I crashed my Ninja Trader. Rule number 1 leads the way, guys. Momentum pushes a market. Momentum can break key areas. Guys, momentum can even cover the mistakes that we tend to make as new users. And when I say we, I most certainly include myself into that, because I've made every mistake that you guys will ever hope to make. And what happens is I've learned how to fix them, and I just pass it right on to you. Once I have momentum, I have to make sure that I'm not trading into an area. The large chart's going to define my areas. And areas on a large chart are where the large crowd are making decisions. Areas on the large chart are where the market can bounce, reverse, fights happen, guys. And areas on the large chart are these horizontal lines, and there's quite a few of them. Actually, there's not that many. We're going to use divergence highs and lows. A divergence high is a magenta line that prints off of a pivot if there was a loss of momentum in that little move. And a divergence low is a cyan line that prints off of a pivot if there was a loss of momentum right there where that market changed direction. On their own, the formation of the line, that's not a termination condition, but you're going to use the trigger lines to determine whether or not it is if price comes back and reaches that line. We're going to use Fibonacci resistance, the red line, and when the market is trending up, this is where the market may stop, bounce, or reverse completely. And then also Fibonacci support, the blue line, and when the market is trending down, this is a spot where the market may stop, bounce, or reverse completely. Yellow 1-to-1s in an uptrend act as resistance. Yellow 1-to-1s in a downtrend behave as support, guys. These are all areas on the large chart, and these are where the buyers buy and the sellers sell and where decisions are made. So in order to determine whether or not they're a termination condition, we're going to go through a pretty simple recipe, guys. We're going to use these areas as our focal point, but we're going to let the T3 trigger lines tell us what the expectation is, or at least what the potential is. So price reaches an area. This is the first part of defining a termination condition, guys. If price does not reach an area, you don't have a termination condition. So price reaches Fibonacci resistance. And remember, Fibonacci resistance can be a divergence high, it can be a red Fibonacci line, or it can be a yellow 1-to-1. And when price reaches this area, decisions are being made. The large crowd's going to make some decisions. Maybe they're going to exit their position. Maybe the large crowd sellers are going to try to flood the market with orders and make it go down. We'll never know what's going to happen, but what you can take to the bank, guys, is that if price reaches resistance and you ask yourself, where are my triggers? And those triggers remain below resistance, this is a termination condition. This is an area that may stop the market. This is an area where fights may happen. And this is an area that could reverse the market completely. And if it does, if price reaches that area and the triggers remain below and those large triggers pinch and roll, that's your reversal. Guys, this is what we call a strong top. And a strong top isn't mandatory for the high probability trend trade, but it adds a little giddy up to any trade that happens after a strong top. If that strong top reverses, the momentum is strong, the market pushes, maybe you're in a short position, and it reaches Fibonacci support, or it reaches a divergence low, or it reaches those yellow 1-to-1s. Decisions might be made. The only thing that you need to do is ask yourself, where are my triggers? And if they remain above support, support's a termination condition, guys. It almost seems too simple, doesn't it? If price hits the area and the triggers remain below, don't trade into the area. The rule's not met. And if price reaches support and the triggers remain above, don't trade into the area. The rule's not met. Guys, these areas are notorious for stopping the market. These areas create big untradeable bounces. These areas create reversals. Very much in large moves, it's these areas that start the big push. So not trading into them is a huge advantage. Trading into them is not. Is everybody good with that? Price reaches, where are my triggers? It's almost too easy. Areas break all day long. If they didn't, we'd be stuck in a range all day, guys. Areas broken. The path is clear when both your small triggers and your large triggers get below the area. It has nothing to do with price bars. Price bars set off the decision-making process. Your trigger lines tell you when an area is broken. So if price reaches support, triggers are all above, sit on your hands, do nothing. You have no idea what's going to happen. Smalls and large get below support. Support's going to behave as resistance, guys, and very often you'll see that retest. Your path is clear. And if your rules are met, take that high probability trend trade short because your path is going to be clear until you reach the next area. Price comes up, hits Fibonacci resistance. All of your triggers are below. I have no idea what's going to happen in the moment. Once my small and large get above it, resistance behaves as support. My path is clear and will remain clear until I reach the next area. And for the brand new user, give it a week while you learn this language. Price reaches, where are my triggers? Let it either be a termination or let it be a clear path. And once you're comfortable with this, it's going to open the door for the second trade that we teach, guys. And this is the 50-50 trade because momentum can break areas. Your trigger lines will show you that potential to break. So price comes down, reaches support, I'm doing nothing because I have no idea what's going to happen. If my small triggers smash, use the word smash, 2 to 3 points through the area, but my large triggers are lagging behind, the look is 50% of my triggers are through, but 50% are not. As long as I have odds favorable momentum, this fib has the potential to break, but it's not broken yet. And if you take an entry based on the potential, it's not a high probability trend trade. It's where we get into this medium probability trade. This will be your second trade, finding a way to capitalize on this look. Guys, this trade has a different set of rules for entry. It also has a different set of management rules. So keep it very easy in the beginning. Let it either be a termination or that clear path that says go. And once you're solid with it, you're going to find your way into the second trade. 90% of your day is sitting on your hands, guys. And there will be times when the path isn't clear because the areas are stacked a bit. I added this into the lesson because I think this is so important because patience is a big part of what we do. Having advantages is a huge part of everything that I teach each and every day. Rule number 2 is the most broken rule because it forces you into being patient, guys. And there will be times where it'll be support after support after support, resistance after resistance after resistance. It happens sometimes, especially if the market's been consolidating previously. Guys, this is 90% of your day doing nothing. It's okay to do nothing. The futures markets trade billions of dollars every day, guys, and it's not necessary to be in every move. And what you'll find is that when you avoid these maybe trades and you focus on the high probability trades, it becomes pretty effortless and relaxing, guys. You don't have to get every tick. Every dollar isn't your dollar. And rule number 2 gives you the ability to see where the driving forces are most likely to react. It gives you the ability to know, where decisions are being made. It gives you the ability to not take that last trade into support or not hope that that momentum breaks this area that's behaving as a termination condition, guys. 90% of your day is waiting. 10% is capitalizing. And rule number 2 does an outstanding job of keeping you out of an awful lot of trouble. So I just opened up crude oil. Let's take a look. So on this particular chart, guys, I've got yellow 1-to-1s, hold, send it right back to resistance, which holds, no momentum, we get a big retracement to the termination, and down it goes. The area breaks, and it's retested as resistance. The area breaks, and it just keeps going down. Mid-band has the potential, resistance has the potential to break, but it does not. And then odds favorable momentum pushes the market down all the way to weaken triggers, where we get the retracement. Guys, that is every lesson that we just talked about on just one chart. So not obligated, but give me a why if you're with me so far. Strong triggers lead the way. Strong triggers can push the market, break areas, cover mistakes, guys. That clear path keeps you from trading into the bounce points, keeps you from trading into the decision-making points, guys. And once you have these two, you're 66% of the way there. Your large chart has done its job. It's time to turn your attention to the smaller, faster chart to pinpoint exactly where the market is most likely to continue. And guys, you're going to do this with such precision that you're going to use a limit order. And you're going to buy or sell a pullback, that little fight from the small crowd, and you're going to do it at areas right inside of triggers. And if I turn my attention to the small chart and I'm like, all right, here we go, time to get a trade, and I see 3 divergences, 3 losses of momentum in the same price range on that small chart, guys, I have to pump the brakes. 3 divergences from a low, 3 divergences from a high is the only time when the high probability trend trade rules are met that I will refuse to take that next entry, guys. 3 divergences may create deeper pushes, full reversals. 3 divergences is the only termination condition on a small chart when the large chart tells me I'm in for a high probability trend trade. But if it's not there, we're going to use that limit order to buy or sell a pullback at an area inside of triggers. More specifically for the new users, you're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. Why favorable, Mark? Because favorable gives you the highest chance of success. Because favorable gives you the least amount of risk. Because favorable is the easiest to pinpoint where the market is most likely to continue. Favorable large triggers means that your large and your synthetic triggers, both on the small chart, your entry chart, are overlapping, one on top of the other, guys, like 2 snakes riding piggyback. And we do this because there is very much a gospel truth in these markets. Price returns to large triggers, whether it's a small chart or a large chart, whether it's a range chart or a day chart. Guys, price returns to strong triggers. It's a moving average and it's a regression of the mean or something like that. One of you math people could help me with the actual term. But price returns to the large triggers on the small chart. Price returns to the large triggers on the large chart. So when the large and synthetic, the large triggers from each time frame, are overlapping, I've only got one spot where I expect price to correct. And then if I put inside of it fibs, mid-bands, yellow 1-to-1s, I give it something to bounce off inside of that correction point, guys. And this is how we pinpoint entries. So I really want you to take this lesson to heart. And I'm going to put this picture in the room. I've never actually dropped it in the room because I give you guys my PowerPoint. But I want you to think about this every time you're looking for an entry. The small chart price may retrace back to the large triggers. And there's 1-to-1s and Fibonacci support inside. And these may produce a bounce. Not the triggers, but rather the areas inside. The synthetics, my large chart may retrace back to these. And I have a mid-band inside that may produce a bounce. So what you're going to do is you're going to begin to say that price may return to these triggers, but it's most likely to continue from an area inside of these triggers, guys. And you're creating a window, you're creating a range where the market is most likely to continue, where the small crowd is most likely to fail. And you're going to do this with an enormous amount of precision. So when the large chart says up, when the large chart has a clear path, everything will be going up on your small chart. You've turned your attention. You're not even looking at the large chart. And you're saying to yourself, how am I supposed to trade a pullback to an area if this darn thing is going up? And guys, your fear of missing out, this is where it starts to kick in. This is where you start feeling like maybe you're not going to get paid. This is where you start feeling like, oh man, I'm going to miss the move. I already missed the move. And then the small crowd shows up, guys, and we end up with this reversal bar. The reversal bar gets us to the downside of the triggers. That's a loss of momentum, and this loss of momentum is really a visual that lets you know, hey, the fight is on, the retracement has started. So once you get this reversal bar, this is not your entry. You're going to say to yourself, where are my trigger lines? Because I know that price may return to the large, and I know that it may return to the synthetic. So I'm going to put a box from the highest line to the lowest line of those trigger lines. And I'm going to say to myself, this is where price may return. This is the range where those price bars may come. And then I'm going to look for areas. These areas are like a brick wall and price is like a tennis ball, guys. These areas define where the bounce is most likely to happen. But we don't know if it's going to bounce from the highest point of support inside of those triggers or if it's going to bounce from the lowest point of support inside of those triggers. So you're going to create what's called the window of opportunity, guys, from the highest point of support to the lowest point of support, all caps inside of favorable large triggers. This blue shaded box defines where the market is most likely to continue, where the small crowd is most likely to fail. Your job will be to study it, to learn to trust it to the point to where you activate a limit order. A couple ticks above that highest point of support. And guys, this is your entry for the highest probability trend trade ever. You have defined the trend. You have established the momentum. You've made sure there's a clear path. You've waited for the reversal bar. You've pinpointed exactly where the market is most likely to continue. And with all that strength and a clear path on the large chart, you've said, I'll get in at the highest bounce point because I'm not going to trip over a couple pennies to save a few dollars. And guys, this is what we're focused on for the first 20 days with Nexgen. Learn to call your entries, pick your spots. Because once you can identify where the market is most likely to continue, you're going to say things to yourself like, well, if I get below those triggers, I'm beyond where the market is most likely to return. If I get below those areas inside of favorable large triggers, I'm beyond where my rule number 3 advantage lies. And anything below those triggers on what I call the wrong side of the triggers, guys, this is not a part of the equation. This Fibonacci support is not a part of the window because it is not inside of favorable large triggers. Everything's screaming down. The path is clear. The momentum is strong. And then the small crowd says, hey, guess what? The fight is on. Here's your reversal bar, Nexgen users. Let's go find those trigger lines, large and synthetic. Let's make sure they're overlapping, one on top of the other. But don't forget that those trigger lines are not your entry. And that reversal bar is not your entry. Your entry comes from the area inside of favorable large triggers. And guys, there's only one, just a mid-band. And this mid-band represents the point where the small crowd is most likely to fail. And this mid-band represents the point where the market is most likely to continue with the trend. Your limit order goes a couple ticks below that mid-band. And you've done everything that you can do. And if they get you, outstanding. And if they don't, it's not your trade. Sometimes they come back for you. But because you pinpointed exactly where the market is most likely to continue, ladies and gentlemen, you understand that anything on the wrong side of those triggers is not a part of the equation. Anything on the wrong side of the triggers is where rule number 3 advantage is no longer with you. So any line on the wrong side of those triggers, guys, is not a part of your window. This is where the market shouldn't go. And that's what defining where the market should continue does for you. It establishes where the market should not go. And that's going to be your initial stop. This is where you're going to say, I know I'm taking a trade that typically wins 70 to 80% of the time, which means mathematically it has to lose 20 to 30% of the time. I'm not going to put a ton of risk on it. I'm just going to put a stop where the market shouldn't go. And if the small crowd woke up and ate their Wheaties, they're going to have to come get me there. Nothing worse than seeing stops inside of that window of opportunity. Nothing worse than seeing stops where the market is most likely to continue because they almost inevitably get hit and the market runs. So your initial stop placement is where the market should not go. 4 to 5 ticks beyond those trigger lines. With the advantage of momentum, with a clear path, with everything screaming down, everything in your favor, guys, you're more likely to get a reversal bar in the direction of your trend. This is actually going to be your first stop movement. 2 ticks above that reversal bar in a short trade, 2 ticks below that reversal bar in a long trade. And what that confirmation bar, that reversal bar does for you is it says, hey, guess what, Josh? Everything's going your direction. This market's moving with the trend. It's moving with momentum. It's moving with that clear path. Go ahead and reduce your risk. And man, if for some reason that small crowd gives us a 180, that's okay, dude. You're going to lose a couple bucks. and you'll be there for the next trade. So guys, defining where the market is most likely to continue allows you to recognize where the market should not go. And guys, that's the high probability trend trade. How cool is that? That was 30 minutes for one trade. 30 minutes to define where the market is most likely to continue. That's the best of the best, guys. Good morning, Miss Cindy. Happy Monday to you. That's the best of the best. Odds favorable momentum, nothing in the way, favorable large triggers. Guys, this is the easiest look. This isn't always the look, and I'm going to tell you this right now. The high probability trend trade in its purest, best, most amazing form is likely to come about 3 to 4 times a day typically. We don't learn it because it's the only trade, but rather it's your first trade. We're learning to read our indicators, and we're learning to use a little bit of language that's going to pay dividends as we look for the next trades, guys. So this isn't always the look. Very often, your triggers are not favorable. They're split. Your large and your synthetic have a division between the two. If you paid attention, and if in your head you say to yourself every time you see this, price may return to these triggers, price may return to these triggers, the logical conclusion is that that's a lot of distance where price may return. This creates a little indecision. And then you say, well, I know that it's the areas that may create a bounce, not so much the triggers. The triggers define where the price may go, and the areas define where it may bounce. That is a pretty good level of indecision, especially if my stop goes down here where the market shouldn't go. Is everyone with me so far? Large chart's perfect. Small chart entry is not perfect. Guys, when your small chart is not perfect, it's okay to insist on one of those reversal bars. To say to yourself, man, it could go from here, it could go from here, and my stop has to be way down here. Let me force the market to tell me it's doing what the large chart says it's most likely to do. Let me force the small crowd to get that reversal bar because it establishes my risk 2 ticks below that bar. And guys, what this does for you is in times of indecision when your entry isn't perfect, it gives you some place to put that stop that isn't $300 or $400 in the distance. You're going to see this a lot. It doesn't mean that the market's going to go up for you. They still may come down, stop you out, hit that next area. You might have to go twice. That happens. It's a part of trading. But guys, this keeps you from leaving $300 to $400 on a trade when there's indecision and the entry isn't perfect. So what you need to do, this is where I take it off of me and put it on you guys. You need to learn these looks so that they become easy. You need to be able to look at your large chart and say to yourself, I have momentum, out loud, scare the dog. You need to be able to look at your large chart and say, my path is clear. Because when you can do that, you're going to say, all I need now is a reversal bar and a pullback to an area inside of favorable large triggers. And this is my trade. And this is exactly what it looks like, guys. And if you go back and study where you circle a tail on the large chart when you've got that momentum, there's 2 of them right there. And that tail pulls back to areas inside of triggers. And look at this. The first one goes, looks good, runs up, make a little money. And then it comes back and the rules are still met, but there's that huge indecision. And if you wait for the confirmation bar, make a little more money. It's kind of cool how that works, guys. But you can go back and study these by simply circling tails when the rules are met. And sure enough, indecision, it did go all the way up to the synthetics, and that reversal bar gets you in the winner that carries you all the way down. This one missed support by a couple ticks. Once again, I told you split triggers are going to be the look. Confirmation bars give you a place to put your stop right up to trouble. Guys, are there any questions about the high probability trend trade? Are there any questions about momentum? Are there any questions about path? I'm going to tell you right now, it takes a little bit of study, guys, and what you have to do, go back and circle these tails. They may not all be your opportunity. But what you're doing is you're beginning to recognize patterns. Right to support, right at the base of those triggers, guys. What a beautiful look. And that's really the key to getting to where you want to be with the software, is recognizing a few key looks pretty quick. And that's where Chart Reading 101 comes in. I'm going to give you all of these things that I'm sharing with you right now, guys. But to get to where you want to be, you've got to recognize these looks. And the easiest way to do it is go take pictures of them. Go take pictures of strong triggers, weak triggers, clear paths, terminations, entry areas. And when you take those pictures, annotate the whys. Get in the habit of writing on your charts a lot, guys. This is why it's strong triggers. This is what it means to me. This is the advantage. This is the rule it pertains to. And if I go take 25 pictures of strong triggers, the likelihood of me mistaking strong triggers for weak triggers goes down dramatically. And if I do the same for weak triggers, the likelihood of me mistaking weak triggers for strong triggers goes down dramatically. Same thing with a clear path, same thing with terminations, guys. And it's the pictures that begin to create the visual, but it's the annotation. It's writing on the chart and saying to yourself, strong triggers mean separations between, well, the small and large in the direction of the trend, like open scissors. This gives me the advantage of momentum, rule number 1. Go through this process, guys. Everybody skips it, and I want you to see something. This is termination. The recipe is always the same, so I want you to write the recipe. Price reaches support, triggers remain above, this is a term, the path's not clear, rule number 2 is not met yet. Sit on your freaking hands and do nothing. Guys, this is the most broken rule. If you skip every one of these pictures and you just take the pictures of termination conditions, it's going to pay dividends. I'm going to give you a high probability trend trade checklist. This is what it takes to get into a trade, both visually and a checklist that you can print out and put on your desktop, guys. Is the market coming from a strong top or bottom? That termination that reverses the market. Remember, it's not mandatory, but it does create warm fuzzies. Guys, strong tops or bottoms does not guarantee the breaking of the fibs. It just creates a little bit of an advantage when the rules are met. This is strength. This is weakness. Know the difference as you take those pictures. Use this to guide you. This is a termination. This is only the potential to break, and that's what it looks like when it's broken, guys. There's your order of events as an area breaks. Absolutely no trade. If the rules are met, advantages are present, take a shot. Best of the best, don't miss it. And exactly where to put your orders, exactly how to define your window of opportunity, guys. And then the second page is the trend trade checklist. I would encourage you to print this out, put it on your desktop, and go through this each and every time you take a trade. Did I have these advantages in place? I've never had anybody use this spreadsheet truthfully and do worse than 70% winners, guys. And the goal is to get paid. I'd also encourage you, I'm doing a lot of encouraging today. As you annotate your charts, write these rules on here. Things that I absolutely hate to see on charts presented in the room. This sucks. I lost. They got me. This is crap. I suck. Guys, that doesn't do anything for the learning process. Say, man, I had momentum or I did not. And if I don't have momentum, then I know that I'm up against a challenge and I may have to manage a little more aggressively. I had no termination conditions, or I did, because if I think I had a clear path and I drop it in the room and Mark tells me, hey, let's go through that recipe for termination conditions. I don't want you to get caught off on this one. And it's okay to make the mistake. Everybody makes it. But here's how you fix it. Let's use that language. Did I reach an area? Where are my triggers? It turns into a lesson. So if you put the language on, we can make sure that your chart reads are correct. And guys, this one right here pays the most because this is the one that defines exactly where the market is most likely to continue. And it keeps you from taking trades arbitrarily with those split triggers from areas on the wrong side of triggers, guys. The language pays dividends. So print that one out. And all of this takes you to the KISS plan. And I give this plan away every day. And guys, I love the KISS plan. And the KISS plan was written for a gentleman initially that was having trouble staying focused. He was having trouble reading his indicators. He was having trouble recognizing these advantages because he was trying to find every move in the market. Um, this KISS plan is a stepping stone in your learning journey. It's the first trade, not the only trade, guys. This is the trade that we use as a foundation. The KISS plan is designed to optimize your chances of success with a high probability trend trade. And that's a powerful word, optimize. This is the best way to take this trade, guys. And then through simulation, study, class feedback, and continuous practice, you're going to craft a plan tailored to your personal goals based on your experience reading the indicators. Once you can read your charts, you're going to see more. Once you read your charts, you'll manage differently. Once you can read your charts, opportunities present themselves, guys. But until you're comfortable with that, until it becomes a little second nature, keep it focused. First trade, not your only trade. So your simple plan is never fight the large chart, guys. Don't fight the triggers. Don't fight the terminations. Go with the flow. Trading can be very much like your favorite lazy river. Just put your sunglasses on, sip a pina colada, go with the flow. You're going to spend a week or two defining your entry area, getting into the market where the market is most likely to continue, because great entries create very manageable trades. Great entries reduce risk dramatically. Great entries increase the distance to profit targets, guys. So define your entry. Make sure that you understand how to get into the market where the market is most likely to continue, because once you can do this, guys, this is where the magic happens. This is where this entry puts you in a position to where you have to manage it. And on the KISS plan, I'm going to tell you right now, management's the second piece of the puzzle. Management is where fear kicks in. Management is where butterflies in your stomach get huge, where palms get sweaty, where heart rates go up. Because once you're in a trade, you have something to lose. That's the perception, right? I think once you're in a high probability trend trade, you have the opportunity to win more than you lose. So until you trust that through a little repetition, guys, your management plan should be very basic. It should be very focused. It should be very mechanical. And it should revolve around your ability to enter where the market is most likely to continue, because it defines clearly where the market should not go. And guys, your first stop placement is exactly where the market should not go. Your initial stop is 4 to 5 ticks above the trigger lines. And then once you're in, you're either going to get stopped out, and guys, this is such a normal part of a positive equity curve. Getting stopped out in a high probability trend trade is likely to happen every 2 or 3 times. Every 2 or 3 times out of 10 that you take this trade. But with all of the advantages, you're more likely to get a reversal bar in the direction of your trend. You're more likely to get that down bar. And guys, this is your first stop placement. Why is that not showing me the right one? There it is. Sorry. This is your first stop placement. If you get a reversal bar, then you will put your stop 2 ticks above it, or for a long trade, 2 ticks below it. The momentum, the clear path, everything is saying, hey, we're going the direction of your trade, guys. So you're going to reduce risk. Once you reduce risk, there's absolutely nothing to do. Put your hands in the air. You're either going to be stopped out for a smaller loss. That's okay. It's a part of it. Or your first target's going to get hit. One of the things that the KISS plan is designed to do is help foster confidence, guys. Build confidence. Get you to the point to where you trust this methodology, because once you trust, you don't hesitate. Once you trust, you're less likely to get caught up in fluctuations on a small chart. So your first target in the KISS plan is $100 away from your great entry. That's it. And with all of those advantages, even if this trade is going to fail, a lot of the times it's going to hit that $100 first, guys. And $100 means you got paid. And getting paid means that you were successful. And being successful means that your confidence is growing. And guys, getting paid is so important. That's the ultimate goal. And as a brand new user, we create these illusions that every trade has to be a big trade, that every swing has to be a home run. Once you get paid, you're going to go break even if you're following the KISS plan. And you're going break even because this is where the trust in the large chart really comes into play. You're going to go break even because this is where you begin to accept that the only reason you entered the market in the first place was because of momentum, because of a clear path, because this is a market that's likely to continue in the direction of the trend. So what that break even does for you is it creates a little courage, and it keeps you from just jumping out. And guys, your second target's only $200 away from your entry. That's it, 200. 8 ticks on the S&P. I'm sorry, 16 ticks on the S&P, 20 on crude oil. And if you reach that area, you're out. If you hit that target, you're out. You're done. There is no more trade. You're not in it anymore. Everything's over. You can breathe. Your pulse can go down. But guys, that's a $300 winner. And when I say that you don't have to hit a home run every time, the idea behind the KISS plan's mechanical approach is to get you paid, is to get you used to being paid, to get you comfortable exiting a market and not caring what happens next, guys. And that $300, if that's the best you do every day, whether it's one that goes the distance or 3 break evens, guys, that's 75 grand a year. That's pretty substantial. This is the beginning. This is remedial. This is 101. This is I'm learning how to trade, how to get paid, guys. You're going to find yourself in this range. If you're following a plan that's been proven to win more than it loses, you're going to find yourself in this range as you develop a management plan, guys. And I work with traders every day, and their range is double this easy. But the goal isn't to make it all on the first trade in the first hour, guys. The goal is to take the best trades, the highest probability trades, the statistical advantage, the one that says, hey, if you take this exact same trade 10 times, your historical study has proven that you win this one more than you lose, guys. And that's why you've got to do some study. And before you ever go live, and guys, once again, let me throw the disclaimer out there. I do it every day. I don't tell one person in this room how to trade. I don't tell you when to enter. I don't tell you when to exit. I don't tell you where to put your stops. What I do is I provide you a plan so you can make your own decisions, guys. I refuse to make those decisions for you. But if you make the decision to go live, there's 2 things that you need to know. You need to know why you will enter your trade, and you need to know why you'll exit your trade, guys. And these are what we call rules. And rules are patterns that have been proven to win more than they lose. Rules create a statistical advantage, guys. And it's your process that yields results. Focus on the execution of the method rather than the result in the beginning. Focus on adherence rather than profit. And the rules are going to help remove the emotion, because once you trust that a pattern wins more than it loses, would you ever be fearful to take the pattern? The answer should be no. You should take it with absolutely no hesitation. But it takes a while to get there. So know what you're getting into so you know how to get out. And guys, once you begin to add things, new trades, different rules for entry, different rules for exit. And if you add a third trade, different rules for entries, different rule for exit. It's okay to get really good at one thing before you try to add things, guys. And this is my first hour. Every hour we talk about the high probability trend trade. Well, Mark, I don't want to be a high probability trend trader. Okay, don't. Doesn't matter to me. Learn how to be a chart reader. It'll open doors. So guys, I am going to drop in the room. I just made this easier. This is a zip file. Extract it anywhere you want on your computer. This is everything that I just presented, guys. This is my PowerPoint, both in PowerPoint and PDF form. This is the chart reading 101. This is the KISS plan. This is the high probability trend trade checklist. This is the exit conditions. This is the daily goals, guys. That is everything. Everything that you need to be successful is in that zip file. The only thing you need to do now is study and practice and present in the room and ask a bunch of questions. And that's what the second half of class is. It is asking questions, presenting, making sure that you're reading your chart correctly. So the second half, I'm going to go through and I'm going to start to look at the pictures that you guys have posted. Here's the deal, and I haven't looked at anybody's pictures yet, but I'm going to tell you right now, I'm really good at reading charts. I know it sounds like a brag, right? It's okay, be impressed. Guys, I'm really good at this. This is why I have the microphone. So don't post a trade in the room with nothing written on it. Don't force me to do your research for you. If you're not sure, say I'm not sure. But I want you to address each and every time you post in the room. I want you to talk about the momentum. I want you to talk about the path, and I want you to show me the entire trade, the entry to the exit, because there's lessons in everything, guys. And if you show me a trade where you claim momentum, but there's not, we're going to do a lesson. And if you tell me your path is clear, but it wasn't, we're going to do a lesson. If you told me that you got in at the area inside of triggers, but you really jumped in the middle of freaking nowhere, I'm going to tell you that's the middle of freaking nowhere. Let's talk about the perfect entry and the correct stop placement. And guys, I don't do this to beat you up. My goal is for you to reach your goals. Annotate, and then we'll go through the read. And by your fourth or fifth chart, here's the thing that's the annoys the crap out of my wife. By your fourth or fifth chart, you're going to begin to recognize more patterns because you're talking about them, but I'm going to recognize the patterns in you. Everybody has a thing. Everybody has a thing, whether it's breaking rule 2 or jumping in early or not waiting for momentum or hoping or wishing or wanting or praying, whatever. Everybody has a thing, guys. I'm going to recognize it, and you and I will work together to fix it. So I'm going to leave you with crude oil. The path is certainly clear. The momentum isn't great, and I don't have any areas inside of triggers. Did you guys see how fast that happens? All I ever do is I talk about my advantages. So before I leave, we're going to do this. Does everybody see how the small triggers are inside of the large triggers and there is not odds favorable momentum? How do I know? Because that's odds favorable momentum. It's always odds favorable momentum. That's not. And then price hasn't reached the area, but we cleared the previous. I have a clear path. Is everybody comfortable with this large chart read? Jim, JK, who else is in here? Red Eye, you in here today? No. You guys cool with this? I don't have the best momentum, but I certainly have nothing in the way. So right now I'm running on 33% of my advantages. If I got a pullback, there's my triggers. There's my area on the wrong side. What does that mean? That means no areas inside of favorable large triggers. Rule 3 is not met. What do you guys think? Does anybody see it differently? Because my hope for you is that with that little bit of analysis that happens in a matter of seconds, you say something clever. Like, why the hell would I trade with only 33% of my advantages? That's a high probability trend trade, guys. That's it for the new users. And let me tell you something. Once you get to the wrong side of the triggers, the mid-band might create a bounce, but that fib might create it. It could be this one. It could go down here. Could be anything over here. Hell, it might be there. There may be a full reversal. I don't know. I've lost my rule number 3 advantage. But that one made it to Fibonacci. So that's not only no momentum, now it's not a clear path, guys. And any longs into that area is financial suicide. What do we have here? This is the S&P. My momentum is looking down, but I'm directly into Fibonacci support. 1, 2, 3 divergences in the same price range. How's that for bringing a lesson to life? This says no short trades. Well, Mark, what do I do if I can't go short? You either wait for it to break or you wait for it to roll. Those are your options. Or you could try to be the guy that predicts it. Rarely works out well. So guys, I'm going to take 5 minutes. Go stretch your legs. It's important to not sit in front of the computer forever. We'll see what happens here on the S&P. I'll be back in 5 and we'll start. All right, guys, I'm back. This is where we're going to scroll to the top and we're going to look through stuff. And I'm going to tell you right now, guys, there's not a lot of pictures posted today. So I'm going to kind of rely on y'all to help me out with some questions. Guys, the S&P large chart says down. The triggers say down. The one thing that doesn't say down are those areas that aren't broken. And it's easy to form opinions. Well, look at it. It's got to go down, right? Well, it had to go down 1, 2, 3, 4, 5, 6 times. let it go. Let it get below. Get your clear path. The momentum is there. You'll find your entry, guys. Be patient. Rule number 2, the most broken rule, says don't do it. Iron Mike, for the S&P and for crude oil, it's an 8 range. The range charts are designed to go with the time frame. If you are trading the NASDAQ, all of the charts are bigger. Your large chart isn't a 13, your large chart's a 34. Your small chart isn't a 5, it's actually a 13. So that 21 range is what you're using for the NASDAQ, but the 8 will get you where you need to be on the ES. And then guys, Pete got us going today. Couple pictures. My dog hates the trash people. Pete says this one took a while to develop. Triggers rolled down, separated, odds favorable momentum, 50-50 entry. Entered at the pullback, not at the pullback to areas inside of triggers, but rather just a little pullback. Great lesson here. And it comes down, and then it pulls right back to the area inside of triggers, and then ultimately it goes down. And guys, this is the difference between novice and experience. Because even on this pullback, Pete knows where the range is. He knows that his stop isn't safe behind this reversal bar because it's likely to become a trend trade, especially on a 50-50. And guys, this is the kind of stuff that you'll find yourself doing as you grow with the software. You're welcome, Mike. This is the stuff that you're going to find yourself doing when you begin to recognize these patterns second nature. And I'm so thankful for Pete's post in this room, because Pete's been reading these indicators long enough that he knows that when a termination reverses the market and gives this level of momentum, it's more likely to go down than it isn't. And he knows that if he gets in too early, he still understands stop placement, and it keeps him in this move. And you'll notice that the small chart, or the large chart, never blinks, and he takes it right to the area. And it's a great trade. It's not a high probability trend trade. This was a counter trend trade. Usually I insist on momentum. Smalls had rolled, were beneath the fib price, but large was still greening up. So Pete, you had 3 divergences. Everything rolled. Everything was below this area of resistance. And you said, what a great opportunity to go down. And you know it's not a home run, and you get paid. Nice job, Pete. Great trading, dude. Heads up chart reading, creating pretty awesome trades. All right, Steve Diego. Steve, I woke up this morning and I actually told myself, when you get to Steve's charts, read every word before you talk about it, because very often I don't see it on the small chart and I go into analysis, but I'm going to get everything here. So price below, large triggers are strong, separated, excuse me. With this momentum and trigger look, price has the potential to reach fibs. I love that. Here's my read. Here's what the read means to me. Cleared trouble. So Steve says, with this look, if it clears trouble, I'm just going to ride that wave of momentum and clear path all the way down to where the market's likely to go. Outstanding. 4-second trade, 2 contracts, 200. Momentum, path, go. I love it. Steve, what a great trade. And guys, recognize this is the concepts from the high probability trend trade. Odds favorable momentum. Let it clear trouble, and you'll find more ways to get paid. And then go in the other direction. Price above the large, strong triggers. Everything says up. You let it clear trouble. And it's not a home run trade. Not a ton of room. So you make sure that you get paid. So what is that? 48 seconds total in the market? 90% of your day is doing nothing, guys. Once you learn to read your indicators, you're going to find your way to get paid. All right, Josh. Weak bottom, yep. Odds favorable, absolutely. Clear path, you've got it. Got out early due to I don't like to be in a trade when the market is 1 minute Perfect entry. That's a strong $62, Josh. Great entry, though. All right, this was Jeffrey Dean. I saw one-to-ones, mid-band, and large triggers come together and set a limit. The red fib was in the way. I tightened my stop, made 180, not thinking is a great entry. So large triggers are down, small triggers are up. Textbook termination condition, big split triggers, you went long. All right. And you made money, Jeffrey, great. I don't know what to tell you. You won't talk about your momentum. You did talk about your path. But, okay, thank you for saying that. Trying to focus just on entries. Entries, Jeffrey, in my opinion, is worth what you pay for it. Entries are a result of the large chart saying that it's time to look for entries. Is that fair? Your entry chart means squat if you don't have the advantages. Jeffrey, I would have gone short here to close the gap back to the large triggers. If I were going to take a trade, an overall trade, termination, white bar off the termination, these triggers are rolling. I would agree. You're fighting everything. The gap theory says we're likely to close the gap. This says we probably put a top in. This split says I have no idea where it can go from, and you even enter on the wrong side of it. And Jeffrey, I love that you got paid, man. And I get excited when you guys make money. I got problems with my workspaces here. But my hope for each of you is that you learn how to make money consistently every day. And Jeffrey, I'm going to show you, and I want you to see this. And guys, I never beat up your trades. That's not my job. But what I will do is with this, I'm just going to take this one look, Jeffrey. And this is for everybody. Jeffrey was nice enough to give you guys a lesson. So price reaches resistance, large triggers below. This is the gap theory. Have you heard of that? So for you guys that haven't heard of it, the gap theory says if price pulls away from the synthetic triggers too fast and too far into Fibonacci area, it's going to snap back to the triggers. So what happens on this particular look is the expectation based on patterns that repeat themselves more than they don't is that the market comes back down and closes this gap. So I don't have momentum. I don't have a clear path. I have a giant gap which creates a pattern that is definitely disadvantageous. And as these are the times where you can say, I'm going to break all my rules and hope, right? And I think that's what happened. Jeffrey, one fib right here changes the whole dynamic of this trade. Coming from a strong top or bottom changes the whole dynamic of this trade. But because it's coming from the middle of nowhere, this is a trade that's going to lose so much more than it wins. And I think that might have been it right there. That was it. It jumped up a little bit, and then it went and closed the gap right back to those triggers. Do you see it? And then once it closes those gaps, a little bit of patience. Now I'm on the right side of everything, right? I got that 50-50, and I've already closed my gap, and things are good. And now I just take that reversal bar, and Jeffrey, it's Cashville, population U. And what you guys don't do in this little section right here makes this one easier to take. And what happens, and I'm gonna air my dirty laundry, what happens is I get so excited about being in a trade. I get so focused on wanting to enter the market that I forget that I need to enter the market with advantages. And this is very short-sighted. I'm reading a book right now. And it talks about shortcuts that the brains take to avoid processing the big picture. And this is very much it. This is your brain saying, Jeffrey, you're the victim here. This is your brain saying, holy shit, this looks nice. And choosing to ignore this because that seems like the path of least resistance. So thank you for the lesson there. I think you got a little lucky. And it did ultimately go back and do exactly what we would expect it to do. And this is why I encourage you guys to just talk in terms of advantages. All right, Cindy, absolutely no annotations. So your husband traded directly into a mid-band from a bad top, fought the small triggers, and got whipped. So here's a lesson that's going back to him. Does husband have a name? He probably does. I'm not even going to go to that one. Svani, that's hard to say. I like that name, though. That's cool. So, bad top, mid-band more likely to hold. That's all. That's not a big deal, but that's just the chart read there. It's this one right here, Cindy. Do you remember that lesson about the small triggers on the NASDAQ? That's it. The look is great. The entry's perfect. He nailed everything. It's those small triggers on the NASDAQ. As long as they're going up, rocketing like that, jumping into the area rarely works. You have to wait for that close on the other side of them. I mean, the large chart's perfect. Mid-band has the potential to hold, create a bounce. Small triggers buy you just that little bit of patience. Does that make sense? And then just, if you want to share this picture. Whoop, that's not it. I can give you this picture because for you guys that want to trade the NASDAQ, I think this one right here, this is the most important picture you can look at, NASDAQ trend traders. You tell him I said it was a good picture. There's a little lesson there that's going to help. What type of dog do I have, Wayne? She's a Corgi mix. She's rad. She is 33 pounds of fury. I love this. Way too many divergence. S&P can't decide what to do. No trades. One of the most brilliant things you could say, guys. And one of the best pictures you can take. Hey, check out this market. None of my rules are met. I choose to do nothing. Wayne, I love those pictures. All right, Rob, we saw this one last week. Still directly into a termination condition. I think you accidentally posted the same one twice. Triggers are up, momentum isn't there. Price reaches an area. Where are my triggers? None of them have broken. This is where you got to pump the brakes a little bit. But what you did is you jumped in at 63.75, which means that you didn't wait for a pullback to an area. You don't have a clear path anyway, and you really don't have odds favorable momentum. This is a tough one. This is a tough one. Go back and use the language every time. Do I have momentum? No, you don't have momentum. This is the one where you traded into the one-to-ones, Rob. Directly into a termination, and you didn't wait for any pullbacks. No clear path. Clear path got you on that one. Pete, first trade was 50-50 entry. First trade was directly into a termination, my friend. 100%. 100% directly into a termination condition, without question. Entered it pulled back to the mid-band inside of large triggers. Wasn't worried about the one-to-ones as it had just penetrated and there was no divergence. And this is, guys, this is when your chart reads will put you in a position to get creative with your rules. Pete says, I have momentum, but I'm trading into a fib. Pete, remember when you used to just go short right there? And he says, with strong triggers and no divergence, worst case scenario is I get a retest. And look at where his profits were. I'm not going to hope it breaks. You knew what you were getting into, not 50-50. But the conditions were right to retest, and you did. And it creates a little bounce. And you said, well, once I get to the other side with all of these advantages, let's go to the next area. I love this trade, Pete. I love everything about it. But you can't call it a 50-50 if none of the triggers are through. It has to be a termination just for the sake of education in the room. You can call it whatever you want, but I'm gonna turn around and I'm gonna change the narrative there. And I guess it's been a pretty mellow day because that's it, huh? Crude oil has weak triggers. Crude oil has 3 divergences in the same price range, guys. Crude oil has no areas inside of favorable large triggers. Not one advantage. Oh, the fake out breakout. Remember when I said, let's just let it break, right? And it never did. Never gets below them, and sure enough, there's a push up. Thanks, rule number 2. Wayne, I bet you're feeling pretty good about that picture right now. All right, I'm going to give a lesson here. 3 divergences in the same price range. Mark, what's the same price range? I get that a lot, and that's a good question. Mark, what's the same price range, right? How do I define that? I want you guys to use the same concept on these divergences as you do on areas. So if small and large triggers do not get beyond the divergence line, it's still in play. So 3 without a break is the same price range. And this is a good example of it because this is where people get faked out a lot. They're like, okay, there's 3 divergences, but there's no divergence here. Do you guys see that? This is a little, I like this lesson. But Mark, there wasn't any divergence, and some of you went short right here. Anybody other than me go short right there? And you're like, wow, I just got my butt kicked. And what I want you to notice is that your small and large never break these divergences. These divergences are still in play. That termination condition is still true. So when you use 3 divergences in the same price range, use the same idea from rule number 2 on the high probability trend trade to determine whether or not those areas are broken or whether those 3 divergences are still in play. And it keeps you from attempting that short even though there wasn't a divergence. Kind of a cool lesson there. So what do I have now? I've got odds favorable momentum. I don't have a clear path. Is everybody with me on this? Large chart read. Have odds favorable momentum. I don't have a clear path. My rules say don't look for a trade. 3 divergences in the same price range with weak triggers. Look at that push down. Pretty cool, right? Same concept. $50-50 look. Large triggers are a full bar away. Now I have a 50-50 look. I do have strong triggers. My path isn't clear. If we were chart reading, this is what we would see. I have odds favorable momentum. 50-50 on area, so path is not clear. Price could return here. It could return here. It could bounce somewhere in here. Stop has to go here. How willing am I to take the trade? That is a weak bottom. That's kind of a weird look on the bottom, Wayne, because your fib update gave all these little inklings of a fib. Something's going on there. Like there were fibs there the whole time. Now we're into the divergence high, all the momentum, and yeah, guys, it's not pretty. But what's the direction? The direction is up. What's the momentum? The momentum is up. So this is one of those times where if I was saying, you know what? I feel like I want to take a shot. My rules aren't met, but my gut says take a shot. Well, I'm probably going to take a shot from an area inside of triggers, right? I'm not just going to jump in. Gotta let it break. Ah, Nanda. I love this. Weak triggers, 3 divergences, everything's rolled, strongest momentum ever, and Nanda says, hey, check it out. There's one of those next-gen momentum trades. And Nanda, the only thing that I would say on this trade, and this is going to be a management lesson. You have 2 fibs in a midband right here. Just be aware that your targets are below all of the areas that may stop the market. And especially when it's a bad top, this is the area that's most likely to hold. And if it reaches it and these triggers are still above here, that's that gap theory. I love your trade though. Beautiful. Momentum, momentum. Let's get in. Oh, excuse me guys, I missed the mute button. And now we're in all the areas. And this is where you can say as long as it doesn't close on the other side of those smalls, it's going down. You guys remember that lesson? I think everything says it has the potential to break. Guys, as long as it doesn't close on the other side of these small triggers, it will go down. How much are you willing to give back? We'll see if 57 creates a bounce though. It's not the gap theory. Now it's just a termination condition. No, that was a great trade. Really nicely done. My rules say I need my small triggers to get below this area to consider shorts. Look at them just hovering. Since there's no pictures, I'm doing this, but I want you to see something. From 10:26 to 10:30, 4 minutes, right? That's all the movement on a small chart in 4 minutes. Why? Because decisions are made at key areas. Because the buyers and sellers, neither of them can win right now. Why do we let areas clear? Because this is what happens at trouble spots. And guys, they're still there. If you don't think 79.50 is important, look at how long the small chart got stuck there. What do you guys want to talk about? This is going to be a long day. Guess we could open up NASDAQ, right? You adrenaline junkies? Why not? Adriana, I will do my best to have an answer for you. Drop it in. Please, please. I love questions. Sometimes they make me look smart. Sometimes they don't. Those are the ones I don't like. I always always mention the need to close on the small triggers. I'll show you exactly what it means. Thank you for asking that. So check it out. Oh, and look at this. NASDAQ's going to give us the perfect example. So Adriana, I am looking for a long trade. Okay, this is the NASDAQ. And let's just say all the rules are met. And Adriana, this is your area, right? That's where it should go from. Wrong one. Are you cool with that? So far, so good? I want you to see something. I'm going to draw this line on the small triggers. Adriana, as long as I don't get a reversal bar, this bar doesn't close on the wrong side of triggers. What direction did that market go? Until it got a bar that was able to close, to finish, to be created. Create the reversal bar. It went up, didn't it? It just kept going up. And so this right here, that's not a close on the correct side. That was a fluctuation that continued up. This wasn't a close. This was a fluctuation, and the bar closed up. Here, it closed. It actually created a whole new bar. And that's what I mean. So a bar close means that bar is done, off to the next bar. So what happens on the NASDAQ, Adriana, on that same idea, as long as the market doesn't close on the wrong side of these small triggers, it's going up. And you can see that it never closed and it keep going up. So if I'm looking for a long trade and those small triggers are absolutely screaming down against me, waiting for the close on the correct side gives me an advantage to go up with the trend. Does that make sense? So as it pulls back for the perfect short, a close on the correct side makes sure I'm on the good side of everything. And down it goes right to the area. And let's see if we can find one that didn't work. For example, and not that you would trade into a termination condition, but if you're like, whoa, everything says up and I really want to go long right here, let me wait for a close on the correct side of those triggers to confirm it. And it never did. And look how far the market went down. And where did it start going up? Once I get the reversal bar or the close on the correct side. Not a close, kept going. Not a close, kept going. Not a close, kept going. Kind of a cool little trick, right? And you can use this on the NASDAQ for entries. And it becomes great on the NASDAQ for entries. But you can also use this on the NASDAQ if you're looking to hold, or really any market if you're looking to hold for a little bit bigger moves. And guys, the NASDAQ is absolutely psychotic. If you've never traded the NASDAQ, it moves about 10 times faster than the other markets. It takes some practice. But here I have a termination. Also got those 3 divergences. We're going to see what it does. Maybe it'll bounce, right? Price reaches support. Oh, what do you guys think about that termination condition? Nanda, do you remember when I said that that's the spot that may stop the market? Let's watch for something. Sure enough, there it is. I love termination conditions, guys. What an advantage. What an advantage to know exactly where the market is most likely to stop and bounce. Show me a picture, Wayne. Cindy, you hate them because you don't believe in them yet. But you will. Keep trading into them. You'll learn to respect them. I don't have anything that precise. 1033.05. Short trade. Where are you talking about? Right here, Iron Mike? Were you talking about trying to short here? Why would you? That's the one. That's the one right there. That's perfect. 566. Oh, why would you short? So Mike, can I approach the language? But my 13 fib said don't do it. Iron Mike, price reached Fibonacci support. The triggers didn't break. You never needed to look at your small chart. That 13.2 fib is actually this fib right here. But this is where you guys have to let the large chart lead the way. And let me show you something that you may not know. And maybe this will help you a little bit with where you're looking. But on the large chart, there's actually fibs from 3 different time frames. So if this were the NASDAQ, your skinny chart that doesn't go all the way, that's your 13.2. On crude or the S, it's a 5.1. Your super fat one is from a higher time frame, and then the ones that extend all the way, those are the ones that are native. And we actually use 3 different time frames because it creates an enormous amount of accuracy. So this fib, it was your 13.2 fib. But you can see it and identify it here on the large chart. And what it keeps you from doing, Mike, I love this lesson because this one took me a while. I love when I can share lessons with you guys that took me 2 or 3 years to learn. So on a large chart, because the large chart leads the way, Mike, a lot of the times you can have this awesome 50-50 odds favorable momentum, totally rad looking picture. But on the small chart, it's going to look like a termination, which means that you can talk yourself out of the perfect 50-50 trade by looking at your fib on the small chart instead of the large chart. Does that make sense? So over here, the small triggers have absolutely smashed. Here, they didn't really make it. This chart says, let's take the short. This chart says, don't do it. It's a termination. And that's the whole 2 time frames thing. You were hoping the 21 would break. I don't even bother. And man, again, this is a great lesson on just verbiage, Mike. If you're looking at the 21 range, but your large chart, if your Renko charts, yeah, don't say go. Don't even look at it. Don't even think about it. Don't even text your friends going, hey, guess what? If this says no, it's a no, because look at how effective this is. 60% of the time, guys, it works every time. Especially on the NASDAQ. Especially on the NASDAQ. So now I got a strong bottom. I've got odds favorable momentum. You've got to. It's funny how it grows too. Mike, it took me forever, and I'm embarrassed at how long it took me to not trade into termination conditions. How do we like this look though? Do I have odds favorable momentum? Absolutely. Well, coming up on the fib, but not quite. So now we're holding. We're waiting. Nanda went long. She made all the money. Unless you went long from here, Nanda, with everything against you, in which case that might not have been your best course of action. I don't know what market you went long on. So this is one of the reasons why I prefer that you don't say, hey, I'm long or hey, I'm short. I prefer that you post a chart, because what I don't want to have happen is somebody to make a trading decision based on what you put in the room, guys. I've seen people so desperate for wins that some Yahoo that's been here for 2 days goes, hey, I'm long on the NASDAQ. And they go long on the NASDAQ in their funded account and get blown out. They're like, well, this is bullshit. They said it was long. No, Guys, you don't know. Some people drink. VIX. I'm not sure what that is. Is that an indicator or is it... I love learning. It's on TradingView, VIX. The fear factor? Right on. Is it an indicator that you can add into it? It's a volatility index. So I could come to my NASDAQ and go to indicators and search VIX. Fear gauge, inverse. Ah! Right on. I don't know what it means, but that's pretty cool. I don't know how to use it. And I love learning new stuff. I really do. But, you know, I was talking to Janesh, the gentleman who teaches the Ale course that a lot of people are taking and doing well with. And he sent me a diagram. It's a flow chart. Do this, don't, had colors, all sorts of stuff on it. And man, the one thing that I'm absolutely sure of, is that less is more for me, personally. Not everybody's like that. And I try to teach this classroom like less is more. Because if your brain is like mine, there's a really good chance that you need it simple. And those of you that don't need it simple will find your way through the simplicity. Why does the large chart show red, but the small chart shows green? Does it reverse? No. So, Nanda, let's go through the basic lessons. And I'll show you exactly why that happened. Nice short, by the way. Right on, Mike. I'm not that talented. I've got 3, but the charts I watch are in front of me. 2 charts on 1. So the large chart is going to define the trend and the momentum in the areas, Nanda. Do you recognize this as odds favorable momentum down? This is a big one. Everything says down. The trend is down, the momentum is down, everything's down. Even on your small chart, the synthetics are down, the large are down, the triggers are below, the area is down. Everything, yes. No, this is for Nanda. Every chart says down. All indicators, momentum, direction, it's all down. You took a long, and that's okay. If that's what you want to do, that's great. But you took a long hoping that these blue lines would hold, right? Is that fair? Look at all these blue lines. I sure hope it goes up. Right. So Nanda, I'm going to show you something here. And you can trade any way you want. Okay. I hoped it would go up from here, and I lost. And I hoped it would go up from here, and I lost. And from here, and from here, and from here, and from here. And all of these fought trend and momentum. And they were all losers, right? You took this trade and it worked out great. But if 1, 2, 3, 4, 5, 6 times just arbitrarily jumping in at a blue line doesn't work or a red line doesn't work, this one you got paid on. So I've got 1 out of 7 worked. That's not winning more than it's losing, right? Maybe not in the plan, because what we're looking for is a statistical advantage. And I hope areas hold all the time, right? I sure wish that one would have held, but I lost. And all of these on the way down, I wish. And anything on the way up, I wish would have held. And what happens is right here, it's very, very aggressive. Does that make sense? Right here, hoping that it holds is very, very aggressive. But if this is really going to hold, Nanda, these triggers are going to roll, and my small triggers are going to get above them. And the market is probably going to give me some sort of chance to take a shot, because this bad top says that this area is more likely to hold, because this rolling says that this is holding, and because these triggers up suggest it as well. Does that make sense? I like your read. I like your thought. But I think what happens is a lot of times we begin to form opinions, and those opinions get us in a little early. And this is one of the pictures that oh my gosh, I put this in the room forever ago, Nanda. Because I had someone that did very much what you did all the time, and they kept getting slaughtered. And they're like, well, what good is Fibonacci if you can't just jump in at it? Well, there's more to it, obviously. We're just showing you where it may. And this is the I think resistance will hold price right here. And that's the whole dance that happens on the fight. And then once everything rolls, it's the same price. Very often, it's the same price. And how many trades can you lose while they duke it out? And that's what we're trying to avoid, is losing all the trades in a fight. And this was one of the ones where the fights weren't that great. But if you went short here, you got stopped out. And then when everything rolled, it made it pretty easy, didn't it? Does that make sense? This was a great example because you killed this trade. Once everything rolled, it was effortless. Until it rolled, there was a fight. I love it. What a great lesson. And it means that you're reading your indicators. It means that you're making logical decisions based on what you're reading, and that's pretty awesome. Cindy, everything says down. You're welcome. From a strong top, 50-50, no divergence. And when you got in here, those triggers were all the way down here, right? Which means that you weren't fighting them at all. You got in at the area. You knew where your stop went. You make some money. Hell, I would have entered again right there. Momentum. Beautiful. And then you got to all these fibs and you said, you know what? Let me give back all of that money. They already told me they were slow, and they said they were doing it again. There's the third time they told me they're slowing. No, I think this was the perfect entry because your small triggers were a full bar away. Good job. I think it's okay to get paid at areas, though. That's a $200 move that you gave back. That undid $200 worth of profit. And you were up 90 to 65. That is what, 25? That's $1,000. That's a $1,000 move, isn't it? Am I reading that correctly? And how much did you net on it? Do you know? I stink at math. I'm sorry. 80. So you got 200 there and about 300 there. So you caught about half of it. Got about half out of the move. It's a beautiful trade. This will absolutely destroy an Apex account if you're an Apex trader. Absolutely destroy an Apex account if you're an Apex trader. Everything says up directly into a termination condition. You take the momentum style entry. That's okay. You're using the termination, the momentum, and saying, Let me get above it on the small chart. I love that you waited. Look at how it created a bounce. You get above it, you get in. And when it doesn't work, you say, with this much momentum from a termination, it's likely to become a trend trade. I know where my stop goes. And then Cindy, beautiful exits, much better exits. Great exits, Cindy. You know what you're doing. That one is today. That's a beautiful trade today. It's easy, isn't it? When it all looks like that. And but you traded into the termination conditions. I think they hate you back. They always create bounces. So Wayne, I'm sorry, not Wayne. Iron Mike. The skinny ones are your small time frame. The fat ones are one above your large chart. And the ones that extend are native to the chart. So you had it backwards. And I put the picture in the room too for you. So this one right here is native that extends. You're welcome. And then guys, let me share something else. When you talk about the things that I'm embarrassed I didn't learn for years. So when I'm looking at the large chart, guys, for my clear path, anything synthetic, whether it is a smaller time frame, these won't print on the most current bar. They wait for the bar to print. Your one-to-ones wait for the bar to print. Your mid-band waits for the bar to print. And we saw this one last week. Just because there's a gap on anything synthetic one-to-one or mid-band doesn't mean that you have a clear path, guys. And you'll see this. It's kind of cool. I had no idea. But see how this synthetic fib isn't printing under the most current bar? It'll finish printing on the next bar. The same is true with the mid-band. The mid-band seems to be hovering. And if there's one-to-one somewhere, they'll do the exact same thing. So the one-to-ones, Kurt, are unique to whatever chart you're looking at. The one-to-ones and divergences are always unique to whatever chart that they're on, because they're created from the swings. No, dude, that's not a bad at all. So your software took, let me see. It took this move down and this move up, and it said, hey, the laws of one-to-one say this is a likely spot for a retracement. And this one is equal to this one. And that's how the one-to-ones come. So they're very, very unique. So you may have one-to-ones on a large chart, not on a small chart. The same thing with divergence. Divergence says the market came down and the market went up, and it uses these bars. And then it's that calculation from this chart that creates these divergence highs and lows. I think that's a great question, because a lot of times people have this and they look at their small chart and they're like, well, I don't have any one-to-ones on my large chart, so this can't be problematic, right? Or they say, my large chart had one-to-ones off in the distance. I didn't want to do anything on my small chart. And just knowing where they come from is pretty cool, and it helps out. So S&P is a little cluster fudgy. NASDAQ. Does everyone see if you didn't fight the small triggers, you didn't take the loser? Do I have any NASDAQ traders? And guys, I know you hate to lose trades. This is a prime example. Adriana, do you see it? That market doesn't go down with everything until it closes on the correct side of the triggers. And then it goes down with everything. The same is true up here. Large chart says down. Small chart keeps you patient. Guys, that's a great NASDAQ picture. I'm going to go stretch my legs. Do the same. I'll be back in 5 minutes. Last hour belongs to you guys. Tell me what we're talking about, guys. I'm going to put the ball in your court. I'm just going to keep my microphone muted until you ask me a question. So I'll see you in about 5 minutes. Here we go, last hour. Man, the NASDAQ moves, doesn't it? The NASDAQ moves. Crude oil. S&P. A lot of good stuff. A lot of good stuff going on. Did you guys see in the trader chat room? I believe it was from yesterday. May have been. Let me take a picture real quick. We're getting close, guys. We are getting close in the Nexgen funding. Trade copiers, allocations. We are getting close. Won't be long. Been putting in a lot of work on it. We're home stretching it. John Novak is testing it this week, putting things in. What do you guys want to talk about? You guys see that divergence high to the tick? Did everybody recognize this as a termination condition? We're just going to be quiet. Yes, Cindy, you didn't. All right. That's the answer I was looking for. So, Cindy, absolutely. So, Cindy, I want you to take this picture and I want you to remember these are the areas that can stop the market. These are the areas that can create a bounce. That's it. Price reaches the area, trigger stayed below. So there's the list as well, just in list form. So if you guys are struggling with termination conditions, you got to go through and you got to know what could create what could be classified as a termination condition. And then I made this picture. I made this one a while ago. Where's it at? Hold on. In regards to those divergences, because guys, termination conditions, the cyan divergence lows, the magenta divergence highs. Guys, these divergences are like a very specific point in the market where not only the in control force, buyers at a top, sellers at a low, not push any further. Uh-oh, take care, Paul. Guys, they had their momentum stolen right at that key specific 100% number. And it creates this line in the sand. Oh, I'm not going anywhere. Not going anywhere, Mike. I'm here till noon. You got an hour with me. So the key price is where a failure has already happened. So Cindy, when you see this one, right here, the buyers couldn't push up and the sellers stole their momentum. And right here, the buyer said, let's try it again. And the seller said, dude, we put a line in the sand. This is where we want it to go down from. And look exactly what it did. Pretty cool, right? That's how those fit in. And now we have a termination, 50-50, divergence printed. Some of you have rules for this trade, some of you don't. But this is a 50-50 trade. 50% of my triggers are through support, 50% are not. There's the NASDAQ directly into the termination. NASDAQ traders, look at your triggers. Does everybody see where they're at? Once it closes above, there it goes. NASDAQ's fast, ladies and gentlemen. NASDAQ is fast. I love it. Love the NASDAQ. But if you're not comfortable with your chart reads, It definitely becomes difficult. What can we talk about? Oh, yeah, you did, Pete. Thank you. Triggers rolled up. Odds favorable. You didn't quite reach the target yet, and you said, man, let's clear it and trade to it. That's amazing. Pretty easy, isn't it, Pete? Momentum and room to the target. Momentum and room to the target. What a concept. I love it. All right, Cindy, bad top. This is the same one. He just annotated it. Bad top, mid-band's the first place for a bounce. Not a termination, but rather the first place for the bounce. And then the entry is perfect. And you get divergence from one-to-ones. And you're absolutely right. There's enough going against this trade. Divergence from one-to-ones. This is one of those times too, Cindy, where a reversal bar pays dividends. Just a little confirmation. It goes a long way. It's still, like, the entry looks perfect. Even the large chart looks great. This is where you have to go a little extra. Bad tops, first place for a bounce. But I think divergence from a one-to-one, wait for confirmation. It just makes it easier. One of the things about the NASDAQ is it moves so fast that even if you don't get your perfect entry, they come back. They rarely straight line on the NASDAQ. All right. Maybe. It doesn't look like it off the top of my head. You've got your synthetics down here, Cindy. All right, Steve B, do the term conditions hold more weight on large chart, or should they be looked at equally on either chart? All right, Steve. I'm going to answer this question in two parts with a little interpretive dance. So the first part is the remedial 101 lesson. The large chart defines direction, it defines momentum, it defines termination conditions. And Steve, this is for, and I know you're a little more advanced, when I'm talking high probability trend trade, terminations are determined on the large chart. The only termination on the small chart is the 3 divergences. Otherwise, it's just an entry chart. And then this goes back to the picture of, let me go back to it. Here it is. What are the fibs? Your large chart, Steve, has the fibs from the small chart. So we're still allowing the large chart to define the terminations, but it has fibs from the small chart. It also has fibs from the big chart, from a higher time frame. So you actually have 3 time frames worth of fibs on here. And we use the fibs on the large chart because we want to use the triggers from the large chart to determine whether they've broken, have the potential to break, or whether the path is clear. And we want the large chart to define that, because you can have the perfect 50-50 look on the large chart. Every rule meant to take the short trade, but on your small chart, these small triggers probably didn't break. And if you let the small chart talk you out of the large chart conditions, you just miss this short trade. And then here, the large chart, the triggers didn't break, and sure enough, that's your reversal point. So does that help? Let the large chart lead the way. That's a large chart termination. Do you see it? to the tick, right? That's actually this fib. The fib that's over here on the large chart is taken from the 5-1. Going back to basics. Everyone does. Everyone does at some point. And man, I'm a huge fan of reminding you guys that you're human, because we all forget. So I get people all the time, and they come in and they're saying to themselves, man, I got to learn to read my charts, right? And what happens is I try to keep you guys really focused. Read your charts. Talk about these advantages. Talk about them every time you want to take a trade. I don't care what kind of trade you're taking. Talk about advantages, guys. Learn to read your charts. And I say it every day. And then what happens is you start reading your charts and you guys get good at it. And you start saying things like, let me know if anyone's ever done this. We'll take a picture of this right here. Eventually you start to say, because of this termination and this momentum, I'll take this trade because I think it should go back up. And has anyone ever done that? You let your chart read talk you into an entry when your rules said don't do it. And I think that that's one of the challenges that happens as we grow with the software, is your chart reading gets better. The patterns that you recognize become more. And you begin to convince yourself that because you've seen the pattern before, it's okay to break your rules. And guys, I encourage you, don't break your rules. If it needs changing, change your rules through study, through process, through feedback. But let your rules lead the way. Let your chart read take you to the rules. And Steve, that's a very common thing, and that's usually what happens when people tell me that they're going back to basics, is they begin to trade their reads, what should happen, rather than what is happening. So thank you for saying that. On the 34 chart, odds favorable momentum past the small blue support fib with room to the next, entry 4 contracts, close at the next fib. How could I have made this a better trade? My 2 cents, Mike. Isn't it crazy how it is easy when you follow rules? My 2 cents, Mike. You have a 50-50 look here. Do you recognize that? Potential to break, right? Beautiful. So one of the things is fibs are where decisions are made. And let's see if we can turn this into a huge... I mean, that's it right there. Decisions being made. Let's go see on the NASDAQ real quick if we can find a good example. And I think this illustrates it pretty well. I'm going to take a picture of this. So, hit an area, decisions were made that reversed it. From the reversal, Mike, huge amount of dancing. Whoops, right around the key Fibonacci area. Do you see that? Big spike, right at a fib. Big spike, right at a fib. Big spike, right at a fib. Spike from a fib. Spike from a fib. So the one thing that I'm sure of, without question, no hesitation, 100%, is that these fibs can create problems. These fibs can create little challenges. And this is just how I talk through it. And I'm going to find your trade real quick. You entered somewhere right here, right? You're like, I've got momentum. Things are good. And you said, I heard you from where I'm sitting. You said with this much momentum, right at a key area. I know decisions are made at this key area. Let me get south of it, right? Let me get away from the bouncy point on my small chart, and I'll get in, and I'll try to ride it to the next fib. That's essentially what you did, right? You identified momentum in the problem. You got to the other side of the problem on your smaller chart and rode the thing. And this is where I would say, this is where my thinking would be. So I don't know that I could have made it a better trade. Since this trade relies solely on momentum to carry me to the next area, if that momentum dies, close on wrong side of triggers. I'll exit and see if it turns into a trend trade. So Mike, I think that you really did everything about as well as you could have possibly done it there. You had the momentum, you had the potential to break, you let it break the actual trouble area. And notice that it kept going down until the close on the other side. And it was 8 seconds. It's a rodeo trade, huh? This is where, when everything is screaming, you could put your stop on the reversal bar marker and force it to do that trade. Like you're in, force it to do that. Because there's nothing worse than getting out at the top of the bar that never closed and it continues down. Trust me on that one, I've done it. I think you nailed it. But the only thing that I tell people on these is that as long as you understand that momentum is the reason that you got in, be willing to let a loss of momentum take you out, if that makes sense, right? Like if you open a business and the entire business is based on chocolate and you run out of chocolate, your business is done for the time being until there's more chocolate, right? And every smart business owner would say that. Well, hell, I can't be in business today. I don't have any chocolate. You don't try to wing it or hope that you can make vanilla taste like chocolate. And I suck at analogies, by the way. So when you know what you're getting into, you know how to manage it. And that's why when you start going outside of the very basics, you've got to recalibrate. You've got to say to yourself, all right, this isn't a high probability trend trade. This isn't the one that typically wins 70 to 80% of the time. And look at that. Termination conditions. Termination conditions. And I told you, Nanda, if it's going to hold and roll, it's going to roll, right? Look at your roll and your pullback to the small triggers. Guys, there's a lot of software companies out there. There's a lot of people that tell you a lot of things. And they've been around for, 6 months, and they're capitalizing on the YouTube and all that. That look right there, guys, Nexgen started teaching in 2004. So Nanda, this is a good one for you because you've got a good eye for this. When a termination condition holds and the small triggers roll on the large chart, sell a pullback to the small triggers. We started teaching this in 2004. And that pattern still repeats itself. And Nanda, very often it looks like a pullback to those large triggers that just rolled. There's a pattern for you. Pretty cool, right? Guys, that trade is 20 years old. And the market still does the same darn thing every day. So you don't have to be first, right? Let them roll it. Be second. Let them stop out everyone that jumped in right here, and then you get in at the right spot. Love it when that happens. 50-50 with divergence. Didn't work. I'll be darned. Can't go up, don't have momentum. Can't go down, don't have a clear path. Rule number 2 is define the exact area that I want to break out of. How does rule number 2 keep me safe? Let's open this one up. Is there something going on in the world? So check this out. This is the exercise that I call the trust builder. Directly back into the area, triggers didn't break, creates an untradeable bounce. Potential to break but doesn't from a bad top, untradeable bounce. Weak triggers right at a fib, and it hits that one that updated. Straight to the termination, straight to the termination, straight to the termination, and then it breaks with momentum. Weak triggers for the reversal, straight to the termination, termination. That one is just ugly. Can go up, can't go short. Termination, 50-50, doesn't break. Guys, this is one picture of the whole day. That might have been the only one. This is the picture of the whole day. For the brand new user, there wasn't a lot of opportunity. But for the brand new user, there was an enormous amount of opportunity to not give away your money. I hope that makes sense to you guys. One of the hardest things that you'll ever do is absolutely nothing. But if you go back and you take this big look and you see how that when areas break, very often they behave in the other direction. And when the triggers don't break, it's better not to go. And guys, if you go back and take pictures, what happens is you begin to develop some trust. Oh, and Nanda, I didn't give you asked me another question earlier, and I didn't answer it. So I'm going to answer it on this one with nothing but trigger lines. You were asking, how come my small chart and my large chart are different colors? And I apologize. I got wound up and missed something on that one. So let me take off everything but the triggers here on my large chart. And this is how colorblind people can define trend if you're colorblind. So when my small triggers break above the large triggers, right there, it paints the background green. That's what lets me know I should be looking for longs. When they get below, it paints it red, and it'll stay red until they get back into it. So what happens is your trigger lines versus the large triggers will paint the background and tell you which way to look for a trade. One of the reasons I can't have odds favorable momentum up unless all of the colors match, because it's the smalls breaking above that does it. And then Nanda, what happens is my large chart, my small triggers are below. But my small chart has a different look. So these are green. And that's why the large chart has to lead the way. And one of the reasons that I don't talk about colors a whole lot in the rules. I do throw that little cheater that you can't have strong triggers unless all the colors match. But I don't say that the large chart and the small chart colors have to match. We go back to the idea that it needs to be momentum and a clear path, and then finally an entry inside of favorable large triggers. Because there will be times when these two don't jive the way they want to, or you want them to. Does that work? Sorry I missed that one. Guys, I'll do that sometimes. I will see something sparkly and completely miss your question. So make sure you ask it again. Thanks, rule number 2. Did it again. What's more powerful, divergence from a high or divergence from a low? Triggers down into support or triggers up into resistance? Look at that. Scrambled eggs, guys. If I don't have my rules met, it's just better to sit on my hands. And then Jonathan, I think you posted a trade. Sorry. Large chart momentum. Trying to see what you did. You went long directly into termination conditions and it didn't work. All charts up. White paint bar. Path not clear and triggers on wrong side of each other. This range is most likely why this trade failed. So let's look at your entry though. So your entry was right here after the white bar. I get it. But you got in before they rolled. I think I can help, Jonathan. No, I think you had the right look, to be honest with you. I think you had the right look, man. You had the termination. So let's start where we're supposed to start. And man, I always say, if this is your last chart, put it at the end. I mean, you don't read right to left in any other scenario, right? And this is just me, and this may not affect you guys. I read my charts from left to right. My entry chart is, my last chart is my furthest right, but you had the termination, all the triggers are up, you didn't have the clear path. You did determine that. Termination, right? Termination, white bar. So on this white bar trade, Jonathan, market shouldn't get below the bottom of that bar. That's it. Market shouldn't get below the bottom of that bar. And it didn't. And it went all the way up to trouble. And I think that's one of the things about these white bar trades is if you jump in all the way up here, risk is huge. But you got stopped out on the way back to the perfect entry spot. Right there, the HVA line, all the triggers rolled, everything set up. I think that, Jonathan, you had the perfect read. You just didn't have the right stop placement. Those one-to-ones messed you up and pushed it down a little bit. Does that make sense? I think you had 100% the right idea on this one. I think understanding where your stops go would have helped a little bit, and it could have helped you decide whether or not to take that risk. But on these range charts, there's the white bar too, right? And it's down. And you really could have taken a short as easily as you took a long. And it's hard, man. It's hard to do that. There's nothing worse than reading your indicators and making a decision and then waiting for the rules to be met for the entry. Look at that nonsense. That NASDAQ's doing a whole bunch of nothing. That termination created odds favorable momentum. That odds favorable momentum
order submitted
gave us the potential to break from a strong top. If I got a pullback, there's my lowest form of resistance. My stop has to go all the way up here. Are we cool with that risk, or should we wait and see? Should we wait and see if divergence is true? Man, gold is like NASDAQ's little sister, Mike.
order canceled.
Do you find gold to be temperamental? I find gold to be temperamental. No guts, no bellyache. I find gold to overrun a lot, to be a little psychotic. I haven't figured out how to trade it consistently yet. I can have days where it's like an ATM machine, and then I have days where it's absolutely nuts. And I haven't seen a pattern yet that makes me feel comfortable with it. I'll play around at night if I'm just bored on simulator. Right on. Man, I'm really hungry, but all the chicken has salmonella. I'm going to go ahead and eat it. 90% of your day. 90%. How much money is traded in crude oil daily? That's the volume. How much money is traded daily? Approximately 5 trillion worth of Forex transactions take place daily, which is an average of 220 billion an hour. $220 billion an hour. I'm trying to make 500 a day so I can clear 6 figures. Termination for the win. Again. Oh, NASDAQ broke out. We'll see what happens. Guys, we got some time. What do you want to talk about? I'm just chatting with my brother, seeing if he has anything smart to say. He always does. NASDAQ, hope you didn't fight those triggers. Man, Steve, I'm going to be excited to see where you found those momentum trades. I like your charts, Steve. What do you guys want to talk about? I'm going to mute the room. Once I get a chart or a question, I'll start talking again. I'm going to go ahead and kill the YouTube channel.